Alright guys, let's dive in here for the watch list for the week of September 13th. So hope you're having a good weekend. So the market here did get a little bit of a dip last week. We'll talk a little bit about this just in terms of, could we see more selling pressure, is this normal, etc. And then I do want to spend a few minutes talking about just a few things to maybe take into consideration with your trading. If you find yourself giving back too much profit, wiping away too much progress every time the market pulls back here. So we'll talk about a few things that can help with that in just a second, but taking a look here, let's start with the weekly chart. I think a weekly chart is a good picture of the trend. Now keep in mind, anything could happen last week, so not even so much thinking about what's going to happen this coming week, we're more so just focusing on what's the market looking like as of right now. So from a weekly chart point of view, pretty modest here in terms of a dip down to the weekly 8 EMA, so it's pretty normal for a weekly uptrend to kind of chop back and forth above its 8 EMA, so I wouldn't say weekly structure really changed there. And you get your 1, 2, 3, 4, 5 or so days of a dip here, but from a daily charts perspective, it's a dip down to the 21, and Friday gets a little bit ugly, but you're kind of back here at -1. So realistically, at least based on where we are right now, the market came back to what I call the buy zone, which tends to be the case after you're hanging out up here at +2 ATR. So certainly we could get a little bit more selling pressure. It does kind of strike me as a bit normal here. So for the Qs, you're up here at 2 ATR, 2 ATR, 2 ATR, and here's your dip to the daily 21. So that's pretty normal, and from a weekly chart point of view, we pulled back to -2 ATR. So the weekly structure is still completely intact here, and the daily chart just pulled back to the buy zone. So again, not so much, here's what I think is going to happen next, just more so Wednesday, Thursday, Friday might have felt a little bit ugly, but just in terms of structure, the Qs, they made a really good push off the 21. They got to about 2 or so ATR, and they pulled back to the 21. And the S&P 500 pushed off the 21, made a nice move into 2 ATR, and we're pulling back to the buy zone here. So we'll see what next week has in store. My point of view is, instead of trying to short the market, instead of getting shaken out of a bunch of long positions, just kind of looking at the last few pullbacks here. And I kind of hate to call it 2 to 3 days of selling a pullback, but I suppose in this market that is our pullback for now. And it's all just kind of normal behavior here in a really strong uptrend. So not to say it has to continue, but that kind of is my thought process here. So we'll see what next week has to bring. And in terms of open positions here, so in both the mastery and the options room, we're heading into next week with positions in Home Depot, which to be flat on a day like Friday is actually pretty impressive. So you have the daily squeeze here, positive histogram, you got your stacked EMAs, and we're looking for Home Depot to push into about 340 plus. So I think pretty impressive that it holds up on its own 2 feet there last week. And I think Snapchat also held up really good as well. You never really got under your 21. Daily squeeze continues to develop here. Histogram goes positive. If the market does turn back towards the upside, you take note of things like Home Depot and Snapchat that really held their structure during the midst of the selling pressure. They could be some of the first names to kind of take off towards the upside should the market turn the corner. So we're long Snapchat and Home Depot. No complaints there. And then SQ, we're sitting through a bit of a dip here on SQ right now. So the game plan at the moment, let's get the weekly chart up here. The game plan at the moment is everything continues to look pretty bullish here on the weekly chart. Stacked DMAs, you have a positive histogram, and it is normal for a weekly chart to just kind of chop back and forth between +1 ATR and the 21 before potentially that squeeze fires. So we are going to hold on to this, or we did hold on to it rather, because this is a key level of support on the weekly chart. If the weekly chart is legit, you should get a bounce here, and if we get a bounce, we'll be in good shape. Otherwise, you start to leak out under the weekly 21, we'll be looking to jump ship. And then we have one more trade here in XLV, which is definitely one of your stronger trends in the entire market. Last week, getting caught up in a little bit of that selling pressure. From a weekly chart point of view, everything still looks pretty solid here. It would be ideal to see it get back above that 8 EMA next week, but essentially we kind of closed right near it. And taking a look here at the daily chart, got to flush down to about -1 ATR. So quite frankly, when you look at a Johnson & Johnson, who really bled out here, or a UNH, two heavily weighted stocks within healthcare. I suppose at the moment, at least to me, it's actually pretty impressive that XLV is kind of faded off down here towards -1. So we got two open positions we got to keep a close eye on with healthcare and SQ here, and then Snapchat and Home Depot looking pretty solid last week, despite a little bit of that noise. So that is what we're rocking with here. But in terms of, again, looking at the uptrend of a market, and just having the understanding that throughout the course of an uptrend, you're going to get these little flushes. Maybe they're to the 21, maybe they're to the 50 MA, maybe they're to -2 ATR. Regardless, you are going to get these flushes here in a really bullish market. So if you find yourself giving back too much profit on those pullbacks, or taking too much damage on these dips, or just these kind of little bursts of selling pressure, if they tend to be an emotional ordeal for you, so to say, here's a few tips on kind of how to combat against that. The first thing I think is important is a swing trader, you want to learn how to do your job and when to do your job. And my thought process is the best time to swing trade, my favorite setup is a daily squeeze in a stock in an uptrend. What I've learned over the years is the best time to trade that setup isn't just when that stock on its own right is looking picture perfect. It's when the market itself is also setting up for its own push to the upside. So for me, when the market back here is setting up at the daily 21 EMA, we have a squeeze, and the Qs are doing the same exact thing. When the major indexes are setting up at the 21, getting ready for their own push into 2 to 3 plus ATR, think of the implications of that, or rather think of the significance of that. The entire market is making a strong push to the upside. So if you can find your favorite setups, but during that moment in time when the market is setting up, you have the wind at your back as a general statement. So, just look at our mastery, for example. August 1st up until this point, last 10 to 12 trades. We'll look at a few of them here, but the major thing I want you to keep in mind is what the market did. The market was setting up at the 21. The market made its nice push to the upside. So doing our job here, we hit NOW, which had the wind of the market at its back. We hit Facebook. We hit Apple. These are all profitable trades. We hit XLC. We hit IYR. A little bit of AMD with some Tractor Supply Company. Yeah, we had losses on the industrials. Small loss there. We had a small loss on Zoom. But out of the last 12 trades that we've closed, 10 of them have been winners. And such a huge part of that win rate there, and such a huge part of making that progress, is that Facebook was setting up when the market was setting up. And Facebook took off when the market took off. Apple took off when the market took off. As did the communication sector. As did the real estate sector. As did Tesla here. We're taking profits on Tesla on that push. So the point being, there's your window of opportunity. There's your moment in time when you're really looking to move the ball forward. Now the second key here is that once the market has reached that point where we're up here at +2 ATR, your number one job is to protect the profits that you made on the way up. So in our mastery, once we see the market is up here at 2 ATR, we put on our profit protection hat, so to say. We have to make a few adjustments, and we have to make a few adjustments so that if the market does in fact pull back here, just like it did, we got to make sure we're not giving back all those profits from Facebook and Tesla and Apple and AMD and real estate, communications, etc., etc. You got to protect those profits. Otherwise, imagine the rhythm you're going to be in as a trader. You make money on the way up, quite frankly. I think just about anybody can make money when the market goes up almost every single day here. You're going to find yourself in a rhythm where you're making money, you're kicking ass when the market is going to the upside, and you give it all back plus some on the way down. Just look at the trend here. It's kind of this self-fulfilling prophecy where you're bringing home the profits and you're giving them all back. And you're bringing home the profits, and when the inevitable happens, you're giving it all back. So once we're up here at 2 ATR, I think it's time to make a few adjustments to protect those profits. So the first thing that we do is scale down in position size. That Tesla trade, for example, just that trade alone, it was about an 8% position size. So, with our put credit spreads, a 2-to-1 risk-reward ratio, you're risking 8%. You're bringing home about 3.5% and change in terms of growth on your account. We're not doing that up here. Once the market's extended, we're going to continue to look to get long. We're certainly not going to look to short this market. we'll continue to get long, but we're going to take 2.5, 3.5% position sizes. That's the first adjustment. Scale down in position size. The second adjustment is give your swing trades plenty of time till expiration, especially with put credit spreads. Trades are so much easier to manage, and you can exit so much more gracefully in terms of controlling your loss the more time they have left till expiration. So when we're up here, we're not looking to take 10% position sizes on trades that have 5-10 days till expiration, because God forbid the market happens to pull back a bit, you're taking some damage there. So scale down in position size, fewer trades. The trades you do take, you get plenty of time to expiration, and then in the event you get a bit of a dip here, you're protecting the majority of those profits. The third thing to keep in mind is there's some beauty here to a little bit of selling pressure. So if you have things coming against it, you got to manage those positions, but really as a swing trader, you should be drooling here at everything coming back to earth. So should the bullish nature of the market continue, look at this. Actually, NVIDIA didn't pull back, so forget NVIDIA. But look at Apple. I mean, is it not nice to have Apple back at the buy zone? I'm trying to hit Apple again. Is it not nice to have Facebook? Facebook didn't pull back either. No, there's Google. Back to the daily 21 EMA. Here is Tesla. I've been waiting for weeks for Tesla to pull back. We're finally getting that here. So a lot of times when the market comes back down to earth a little bit, you might take a couple of licks on the way down, but there should be a part of you that's realizing that potentially this flush in the market is bringing the Apples, the Googles, the Teslas, the strongest names in the market back to the buy zone. That 2, 3, 4, 5 days of selling pressure, it might offer you your next 10 solid trades over the next 1, 2, 3, 4 weeks. So there's some beauty to the selling pressure. The fourth thing to take into consideration is, in my opinion, if you can become one of the better traders in the world, one of the top, 10% of people who ever try to do this, you're probably going to have like a 60 to 70% win rate. Now, of course, the market can continue to go higher and individual stocks can just sell off and they get bad news, etc. But just think it in terms of probabilities. More often than not, you're going to take your losing trades typically when the market is pulling back here. So thinking in terms of just, reality, losses are a part of the game here. This is probably when you're going to take them. So the message I'm trying to get across here is you want to get in rhythm with the ebbs and flows of the market. When the market itself is setting up at the 21 EMA, and it's in a squeeze and it's building up energy for that next move to the upside, that's when you get busy. And we got busy in the mastery. Tesla, Facebook, Apple, NOW, real estate. We're taking action here, and then as the market releases all that energy, makes that move to the upside, you're taking profits into that strength. And then you're not hitting the brakes. You're just taking your foot off the gas a little bit. You're just slowing things down. Scale down in position size. You're taking less trades. You're giving plenty of time to expiration. That way, if the market pulls back, you're protecting a vast majority of those profits, and you're ready for the next round of trades that the flush might present over the next few weeks. So I think for newer traders, that's something to really keep in mind here. This is typically where you're going to get back a little bit of profit, and this is typically where you're going to make the vast majority of your profit. So make those simple adjustments, and your profitability is going to kind of be in rhythm here with the ebbs and flows of the market. When the market makes that nasty push, 2, 3 weeks of momentum, you're going to be kicking ass. But because you make those adjustments, when we do pull back a bit, you're protecting a lot of those profits there. So a few things I want y'all to take into consideration. I do know that these 2 to 3 to 4 day dips in the market can be very emotional for a newer trader, but understand it's part of the game. It's part of a bullish market, and we'll see what next week brings, but all kind of strikes me as normal. But I do appreciate you watching these videos as always. I'll be live Monday morning for some pre-market prep. We can get a little bit more specific as to what setups I'm interested in, a few potential trade ideas. But that's where we're at right now with the mastery here. Out of our last 12 trades that we have closed, ranging from August 1st, which is basically the first full month of the mastery, up until today, 12 trades, 10 of them are winners, 2 small losers. That's exactly what we want to accomplish when the market makes a push to the upside. Now imagine, just for conversation's sake, we got to take a small loss here on SQ. Maybe we take a small loss here on XLV. I think Home Depot and Snapchat are going to be just fine here. In my book, that's picture-perfect trading. You identify when the market is setting up. You go look for the best examples of your go-to setup. You take your positions. You take your profits into the strength of the wind at your back. Then you scale down in position size. Take fewer trades. Give them 30-plus days till expiration instead of 3 days to expiration. You're trying to protect the gains. Simple as that. So I hope you enjoy your weekend. Appreciate you watching. If you haven't already, go on ahead and subscribe. And I'll be talking to y'all in the next video. Peace.